Hello and welcome back. In this lesson we're going to discuss Chapter 15. Last time, Chapter 14, we discussed the benefits, the advantages of debt. And we sort of left the situation, left you feeling that perhaps since the more debt you add, the more value you add to the firm, that maybe we should just keep adding debt forever. Maybe there should be no limit on the use of debt. So in this chapter we're going to mitigate that and discuss why we should restrict our use of debt. The concepts, we will talk about the costs associated with bankruptcy, give you a few examples, and talk about some of the theories that address the level of debt the firm carries, the trade-off theory, the signaling theory, the agency theory, and the pecking order theory, and talk about some real-world factors that affect the level of debt to equity. Chapter is outlined as shown here. And I assume you have a book and this is a waste of time to go over. So the costs of financial distress come in two forms, direct and indirect. The direct costs are of course the time spent in court and the administrative costs of dealing with the bankruptcy. But the indirect costs, the inability, the impaired ability to conduct business, lost sales and restrictions on activities that can be engaged in, and agency costs. And we're going to look at three different forms of agency costs. The first is the incentive to take very large risks. The second is the incentive to avoid kind of the sure thing. And the third is to milk the property. So let's look at a company in distress. On the books, using historical data, company has $200 of cash and the bonds are worth $300 and the equity is worth $300, the assets therefore $400, and we have a balance sheet that balance. However, the firm is in financial distress and the assets in this company are worthless, and so all we have is the cash, and so the assets are $200, and since assets equals liabilities plus equity, that must mean that the liabilities, well, let's have a look. If the firm were liquidated, the debt holders would be paid $200 and the shareholders would get nothing. And so the value of the bondholders right now, if the firm were liquidated, the market value would be $200, bondholders are already have lost $100, and the equity holders have lost all of their money. So what if the, let's put it this way, would you be willing to buy a lottery ticket with someone else's money? And I think almost everyone would say, sure, I'll buy the lottery ticket, and of course if I win, I'm rich, and if I lose, I'm not out anything. Well, that's exactly what this strategy is, a selfish strategy. The shareholders using the bondholder money to take excessive risks. So here's an investment. There is a small probability of a very big payoff, and a big probability that you'll receive nothing. And of course the expected payoff on this investment is 10% of $1,000 or $100. So here's an investment that costs $200 and pays back $100, and the required return being 50%. Now why is the required return so high? Because this is a very high risk proposition. And so if we calculate the expected cash flow from the gamble, it's $100. And the net present value using a 50% discount rate is a nice negative 133, and nobody ought to take a net present value investment that has a negative value. However, in this case, let's look at the situation. The cash flow to the bondholders. If we do get the $1,000, the bondholders will get their $300 back. So they will have put in $200 and they'll get back $300, but there's only a 10% chance that'll happen, so the expected payoff to the bondholders is $30. So we're asking the bondholders to put up $200 with an expected payoff of $30, and the stockholders to put up nothing with an expected payoff of $70. Of course, the stockholders like this idea. The present value of the bonds without the gamble is $200, and the stock without the gamble is nothing. But with the gamble, the present value of the bondholders, take away the $200 and give back the 10% of $300, you have a present value of $20, and the bondholders, stockholders have a present value of $47. So they went from 0 to $47. Now, the second strategy is underinvestment. Now the question is, would you take a sure thing? Would you take an absolute positive net present value sure thing if you were going to receive the small end of the benefits? So here's a very good government-sponsored project. It guarantees $350. Notice the word guaranteed. $350 in one period. Costs, however, $300. Now, the firm only has $200. So if the firm is going to invest in this, the stockholders are going to have to put an additional $100 in. Now, let's see. Would you put $100 into basically a firm that has no value to you just so you can get a payback? Well, what would their payback be? If the project is successful, they will get $350, but $300 of that will go to the bondholders, and so the stockholders will only get $50. So would you put $100 of your own money in if you were going to get back $50? And the answer, of course, is no. The net present value of this project is positive, and the project should normally be accepted, but the bondholders will get $300, the stockholders will get $50. And the present value of the bonds without the project is $200, and the present value of the stock is $0. The present value of the bonds with the project, well, they get $300, and so the present value of the bonds would be $272. Remember, they gave up $200, but they get back they get back $300. And the present value of the stockholders would be minus $54. In other words, we put in $100, we get back 50, present value of 50. So the net present value to the stockholders is minus 54, and no stockholder would do this. So the selfish strategy, let's not take let's take really risky projects, but let's not take good projects. That's the situation we find ourselves in with this undervalued company. The third selfish strategy is for the stockholders to milk the property. And that just means let's just steal. Let's pay ourselves a $200 dividend and leave the firm insolvent, leave the bondholders holding absolutely nothing. Now, of course, bondholders know that this situation might happen, and so they write into the bond indenture, into the contract with the stockholders, the requirement that they can't do this sort of thing without permission of the bondholders. Another thing stockholders can do is start consuming a lot of perks, expensive plane rides, fancy parties, all kinds of frivolous things that they could spend the firm's money on. Well, can the cost of debt be reduced? Well, certainly. If you know that this sort of activity is going to occur, then one of the things you can do is in advance adopt protective covenants so that you can prevent these things from happening. You can take a kind of a proactive policy. Another is debt consolidation. We could perhaps minimize the number of parties and therefore the contracting costs will fall. Now, what about the tax effects? We talked in the last chapter about the benefits of the tax benefits of debt, and we said because debt is tax deductible, because the interest is deductible, essentially the government pays for part of the debt, and therefore we have what appears to be an unlimited opportunity to increase the value by adding more and more debt. But there is this thing about financial stress. Now, I'm not going to belabor the point, but I want to make this point. There is no single factor that I can think of in the world that causes companies to fail more often than does excessive debt. So, financial distress. There's certainly a trade-off between the tax advantage of debt and the costs of financial distress. So it's difficult to express this with a precise formula, but graphically we can draw sort of a picture. So the blue line here is what we saw last chapter, Miller and Modigliani Proposition 2, in a world with taxes. As the firm adds more debt, the levered value of the firm equals the unlevered value plus the tax rate times the debt. However, notice the red line, which includes the value of bankruptcy. And as we add more and more debt, the value of bankruptcy is negative. The financial distress, the cost of financial distress, begins to drag the blue line down, becomes the red line, And the red line begins to slow its rise until we reach B star. And at B star we've reached sort of an optimal level of debt. And then the trade-off beyond that point, adding more debt just increases financial distress costs faster than we get tax benefits, and we start losing value. So B star is the optimal level of debt. And there's the present value of the financial distress costs. And as they point out, it's very difficult to exactly quantify that, create a formula for it, but it's certainly there. Now let's go back to the pie model. We can view taxes and bankruptcy costs as another claim on the firm's cash flows. Now before, we had that the value of a firm is equal to the value of the stock plus the value of the bonds. Now we're going to give the government a little piece of the pie, and we're going to give lawyers a little piece of the pie. And so the value of a firm is equal to the stock plus the bonds plus the government value plus the L. And so what happens here is that as we begin to add a little debt, the pie starts to become bigger. But as we go beyond a certain point, G and L begin to gobble up resources faster than B can create them, can shelter them through its tax benefit, and so the pie begins to shrink for the claimants of the firm, that is the stockholders and the bondholders. Now, a second theory is signaling, and the idea of signaling is that debt can serve as can be a way for management of a firm to send a message to shareholders about how they feel about the future of the firm. So the firm's capital structure is optimized where the marginal, going back to the trade-off theory, the firm's capital structure is optimized where the marginal subsidy of debt equals the marginal cost. But investors can view debt as a signal of firm value. And the reason debt works is because it's an expensive signal. And sending a false signal actually will cost more than sending a true signal. So firms with low anticipated profits will take on a low level of debt simply because they know that they can't afford a lot of debt. It'll get them into trouble and they'll fail. And firms with high anticipated profits can take on a high level of debt. So in that sense, in the signaling sense, we would expect debt to increase adding debt at least, to increase the value of the firm because it's interpreted by shareholders as a signal that the firm believes, management believes, that there are good times ahead. So a manager takes on more debt than is optimal to fool investors. Well, he's going to pay a very high cost because he's not going to be able to sustain the payments on the debt. The firm is going to go into trouble and the shareholder is going to punish it severely for sending this false signal. Now, the agency cost of equity. We know that people work for incentives. An individual will work harder for the firm if he's one of the owners. And that's exactly one of the reasons that we give owners stock options, and we create incentive stock options and other kinds of devices that allow the owners to be, the managers to be owners of the firm rather than just employees. But even though managers may have a motive to partake of perks, in other words, to kind of steal from the firm, they also need opportunity. And how can you have an opportunity? You can have an opportunity if you have a lot of discretionary cash. And in the corporate world, we call discretionary cash free cash flow. So that's cash flow that isn't committed to anything and can be spent for somewhat arbitrary purposes. So there's this free cash flow hypothesis that says basically, if you take away the free cash flow, you deprive stockholders, you deprive management of the ability to use that for wasteful activities. And you can do that in two ways. You can either increase dividends, so you give some of that excess money back to shareholders, or you can increase debt, in which case you basically bond or commit yourself to making those interest payments, and that reduces the amount of free cash flow. Now we have the pecking order theory. The pecking order theory states that firms prefer to issue debt rather than equity if internal financing is sufficient. So first of all, firms would rather use internal financing. If they've got to grow, the number one preference is to take money that's already in the firm, available operating cash flow, internally generated cash flow. Then when that's gone, the next thing that firms want to do is issue debt. And the last thing they want to do is issue new equity, because that sort of dilutes the pie. When you issue new equity, you add more owners to the mix, and therefore you dilute the ownership that you have. Now, the pecking order theory is at odds with the trade-off theory. The trade-off theory, remember, suggested that as we add more debt, the financial costs of distress begin to weigh against the benefits of debt, and we had an optimal debt-to-equity ratio. But in the pecking order theory, there is no target debt-to-equity ratio. Profitable firms simply use less debt, and companies like financial slack. So companies prefer to use neither debt, no debt, no equity. Now, growth and debt to equity, growth certainly implies that there will be more internally generated funds, and therefore it implies more equity financing, even in a world with very low bankruptcy costs. So high growth firms, we would think, would have lower debt ratios than low growth firms. That's one of the implications of this theory. And growth is, of course, an essential feature of the real world. As a result, 100% debt financing is suboptimal. How can firms establish capital structure, or how do they? If we look at the real world, if we go out and look at companies, and you could do this very easily. If you get on Google, for instance, and get on the stock screener and look at the debt to equity ratio, and just ask how many firms have, for instance, a debt to equity ratio below 1, or how many have just pick a certain level. Most corporations, you will discover, have a fairly low debt to asset or debt to equity ratio. And you will also find that changes in financial leverage, it's observable, changes in financial leverage affect firm value. Stock prices increase with increases in leverage and vice versa, and that's consistent with the Miller and Modigliani theory about a world with taxes. Another interpretation is that when firms add debt, they're signaling good news, and that causes the stock value to increase. But there are differences in capital structure across industries. You will find some companies, for instance high-tech companies, typically have had very low amounts of debt. Banks and financial institutions typically have had very high levels of debt. There is evidence that firms behave as if they had a target debt to equity ratio. So what are some of the factors that help establish a target debt to equity ratio? Well, certainly taxes. As Miller and Modigliani point out, debt is tax deductible, and therefore it allows more of the firm's cash to go to its claimants, if we say claimants are stockholders and bondholders. So taxes are certainly an important part of debt to equity ratio. So are the types of assets. The cost of financial distress depends on the type of assets. A firm that has a lot of operating risk, for example, maybe in a very cyclical business, would not want to add to that a lot of financial risk. Uncertainty of operating income. So even without debt, firms with uncertain operating income will have a high probability of experiencing distress. And you certainly wouldn't want to add debt to that mix, because that'll just make that situation worse. And the pecking order and financial slack theory states that firms prefer to issue debt rather than equity if internal financing is insufficient. Let's talk a little bit about the bankruptcy process for corporations. It's just some terminology. Business failure means that the business is terminated without a loss to creditors. Legal bankruptcy is a process in which the court takes over, and the federal court oversees the process of bankruptcy. Now, technical insolvency means that a firm is unable to meet its debt obligations. And accounting insolvency means that the book value of equity is negative. However, the firm may still be able to meet its obligations. I will point you to General Motors. General Motors had, before the government finally stepped in and bailed it out and it was bankrupt, had about $20 billion of cash. and yet the assets were less than the liabilities. So the equity was actually negative. The company was insolvent from an accounting point of view, and it was burning through its cash at about $4 billion a month, but it wasn't technically insolvent because it was still able to meet its debt obligations. It had the cash. See the same thing with a young doctor coming out of medical school. They may be underwater as far as their net worth, but they're generating enough cash to cover their expenses. Now, there are two kinds of bankruptcy. There is Chapter 7 and Chapter 11. Chapter 7 is liquidation under the Federal Bankruptcy Reform Act of 1978. And in liquidation, a trustee takes over the assets. This would be a court-appointed trustee, sells the assets, distributes the proceeds according to a priority rule, a pecking order, if you will, and then the company ceases to do business. More common probably is a reorganization. That's Chapter 11 of the Federal Bankruptcy Reform Act of 1978. And again, this is a court-overseen process. This time, however, the court allows the company to continue operation and just provides it shelter from its creditors. Now, the creditors may get some money, but they'll probably only get pennies on the dollar. And they'll have to take that, and that'll settle their claims, and the company will come out of the bankruptcy process without debt, a leaner, meaner company able to operate and function. So we saw Circuit City. Circuit City went through a Chapter 7 bankruptcy. Further back, we saw Kmart, which went through a Chapter 11 bankruptcy. General Motors went through a Chapter 11 bankruptcy. All right, that concludes our discussion of debt. So let's take a little quiz, as we usually do at the end of these things. First of all, what are the direct and indirect costs of bankruptcy? And we talked about the direct costs, the legal and administrative, and we talked about the indirect costs. You remember the three games that we talked about, maybe taking very speculative bets and not willing to take certain things and just stealing from the company. The selfish strategies stockholders might employ, well, I just basically got a little ahead of myself. That's what they were. Explain the trade-off, signaling, agency cost, and pecking order theories. You should be able to explain those. I'm not going to go back over them, but if they're not clear in your mind, go back and review them. Remember, the trade-off is between the benefits of debt and the costs of debt. And we reach an optimal debt level where the marginal benefits equals the marginal costs of debt, and signaling agency and so on. And finally, what factors affect real-world debt? And we talked about a number of factors, including taxes, that affect the real-world level of debt. And that concludes our discussion of Chapter 15.